impact and no share dilution at a Thyrocare level. It's mostly at the parent level. So
yes, correct.
Does that explain that?
So how it looks at the parent's balance sheet? I'm just curious to understand how it.
So the same is reflected in our P&L as a charge, and whereas in the balance sheet, it's contribution from parents shown as in our balance sheet.
And in the parent balance sheet, it is basically share-based payment to the subsidiary.
Got it. And why not the Thyrocare shares itself?
The pool that when we wanted to create a sufficiently large pool, the pool available at Thyrocare was not large enough to appropriately incentivize the leadership team here.
Got it. Okay.
And if you go for additional pool, then it go for dilutions of shares, which you don't want at this point of time as an impact.
Got it.
So that was your first question. Second is employee count. See, the employee count largely is because if you go back to 2019, I think we had 10 labs. Today we have 30 labs. And that is largely the increase in employee cost, running 10 labs versus 30 labs. And the second is we have put a lot of investment in feet on street and outbound calling. So that is the other. But, if I break up that journey from 1200 to 1900, I would say almost 80% of that will be largely because of the number of labs that we have opened. And the remaining will be in business development and all of that.
Got it. And when do you think the utilization of those will go up so that we have an operating leverage? Is it like, are we 10%, 20% utilized of the incremental headcount? What is the normalized employee cost or something which we can actually expect?
Look, our labs, actually, we are now reasonably efficient from a lab point of view. I think our overall utilization will be in the 60s, which is a good, comfortable position to be. Because this business is seasonal plus seasonal in the week as well. So, the peak versus trough is quite substantial, both at a weekly level as well as monthly and quarterly levels. So I think 60 to 70% utilization is a good place to be. If you see over the last couple of years, last year to this year, we haven't added much headcount, at least in lab operations. So you should start to see the operating leverage come in, especially now that we are growing at 16% plus. Then you get if you go back to previous years, at an overall revenue level, it was while we were growing on non-COVID basis, at the overall revenue level, we were not growing.
Got it. So we can take around 200 employees per year. It would be an increase to support a 15% growth in the top line.
I think as a percentage, you should, roughly expect the employee cost to track 0.75 of the revenue. If your revenue is growing 16%, you can anticipate employee cost to grow 12%.
Got it. Okay. Fair enough. Yeah, and the third is regarding African.
So Africa, I think we spent 8 crores, no?
We spent 8 crores, and as of now, we have no plan. Further plan is going to come depending on how the outcomes are going to come.
Yeah. So at this point, our capital outlay in Tanzania is actually not even 8 because half is 4 from us and 4 from the partner. So yeah, it's actually a total of 4 crores.
Provision 4 crores for further expansion.
So just one last question from a rent point of view. What is the annual rent expenses you have for all the 30 labs approximately?
I don't think I have that number on hand. Maybe Alok will look at it and come back. Maybe go to the next question. I'll interrupt the call at some point and give you that
Thank
number.
You.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now.
Go ahead.
We have a question.
Rent is around 60 to 70 lakh rupees we are spending monthly basis for all 30 labs.
Should we take the next question, sir?
Yes, please.
Okay. We have a question from Neeraj Vijay Kamtekar from Prospero Tree. Please go ahead.
Good evening, sir. Sir, my question is regarding the subsidiary company, that is the radiology business. Sir, we have a meaningful investment in the radiology business, but the contribution is very, very less or hardly there is any contribution at the bottom line level. When this business will really contribute to the balance, to the bottom line? Because only the pathology business is performing, radiology business is not performing. We have increased the number of centers from 9 to 10, but there is a very hardly there is a revenue improvement and the profit is very negligible. So my first question is regarding the radiology business improvement.
So again, I'll take you to the history before I answer that question. NHL used to be a loss-making entity. At least now it is no longer loss-making and not negative in the P&L. That has taken us about a journey of almost 2 years to turn around this business. Now that it is profitable, yes, I agree with you. It is not generating a lot of profit. A primary reason of that is because the maintenance cost of the equipment has gone up substantially because the equipment is very, very old. So we would have to invest substantially in this business if we are to expect this to come into a meaningful contribution overall. As it is currently, I don't expect the business to do much. I mean, we can take the business up a little bit. The 1 crore EBITDA may become 2 crores, but in the 45-50 crores that we are targeting, it will not be meaningful. But if we are going to make this a meaningful business, we are going to have to invest substantially. And for that, we are making the plan. Now that at least the business is not loss-making, we are now more confident to evaluate investments there. But the investments will be substantial. So therefore, we have not taken that decision at this point.
Good.
Mr. Neeraj?
Yeah.
To answer the question,
am I
I would
audible?
not bank
Yes, you are.
much on the. I would not bank very much on the radiology business becoming a substantial contributor of the profits.
Sir, because my question is when the originally the Farm Easy has taken over the business of the Thyrocare, there was a substantial investment earlier also. Now we are putting more money into the radiology business, which is not generating the desirable IRR from that business. Why we are insisting on the radiology business and why we are not concentrating only on the pathology business?
No. So let me clarify. We have not taken any decision to invest in the radiology business. We are currently happy with where it is just now. It is not loss-making. It adds and it is not cash flow negative. So with that, we are happy with where the business is now. All our focus is on the pathology business, which hopefully you are also seeing in the figures. We will continue to maintain the radiology business, but rest assured, not a lot of management bandwidth is going behind the radiology.
So now onwards, there will be no major capex for the radiology business. Is it correct?
It is not anticipated. If we have it, we will of course first consult with the board and make a thorough plan. But as of now, there are no plans to substantially invest capex in the radiology.
Okay. And sir, my second question is regarding the cash flow. Though the company is distributing the very good amount of the dividend, but when we declared and we paid the dividend, we have to encash some investment which we made into the mutual fund or somewhere else. So is there can we curtail the dividend and maintain the investment for the future possibility of investment, other investment in the business investment? Or will we maintain such high dividend every year? So because in the first half, mostly we divest some investment and pay the dividend out of that money. So can we have a minimum amount of dividend and keep the investment for the business purpose? Is it possible?
That is always possible, but right now we are generating a healthy amount of cash flow. Even in the first quarter, our cash generation will be, I think, close to 40 crores. So we generate 150, 175 in that range of cash every year. We don't require that much cash. We are almost a negative working capital business to some extent. So our cash requirements, even to grow the business, are not substantial. So then we feel it's better to reward our shareholders with a good dividend rather than keeping the cash in our treasury.
But then
Mr. Kamtekar, I request you to join back the queue, please.
But my question is not over, madam. I will join in the queue, but my question is not over.
Please take this question. No problem. Please continue. Please ask question, sir. Sorry.
Sir, I believe his line got disconnected. I'll take the next question. This is from the line of Aditya from Securities Investment Management. Please go ahead.
Hi, sir. Thanks for the opportunity. So firstly, how do you define a large and a small franchisee? So is there any revenue target set for a franchisee to become large or small?
Yeah. So, at Thyrocare billing level, a large franchisee is, I think, 50,000 rupees plus. And small franchisee is someone who does less than 50,000 at Thyrocare billing, which, just to give you context, while the thyroid MRP is, in the range of 300 to 350, our billing to the franchisee is roughly about 60 rupees, 60 to 70 rupees, you can take it. So when I say it is at Thyrocare billing, it is a multiple at the franchisee level. But that's the definition, more than 50,000, less than 50,000.
Understood, sir. So this franchisee business, who would be our major competitors? Would it be the larger listed players only, or there are smaller players as well?
There are competition. I'll let Nitin take this question.
Yeah. So the competition is also very, very area specific. The competition comes from both sides. Large established players like Metropolis and Lal, and in certain areas there are a lot of local players as well, which are very, very region specific.
So, but if I have to understand the kind of volumes which the larger players would be doing, the cost advantage which we would have, those cost advantage the smaller player shouldn't have. So ideally, the larger player should keep gaining share in this market, right?
Yeah, I think both in terms of share and profitability. If you study the larger players versus the smaller players, you will see both from a growth rate point of view as well as from a profitability point of view. The larger players which are listed stand out, and if you study any of the unlisted, you will not see similar growth or profitability in many of those businesses.
Understood, sir. And sir, now this partnership business excluding API and government, we have been seeing very good growth. So is this growth coming from new partners, or there has been increasing contribution from existing partnerships?
I'll let Nitin answer.
Yeah. So it's a mixture of both. Like Rahul said, a couple of years back, the partnership business was negligible. And like if you see last year also, we added major partnerships during the quarter 1 and quarter 2 of last year, which are giving us the desired results this year as well. So it's on both sides. While we continue our efforts on adding new partners, but on the other side, for players like corporates and other insurance partners, we try to get in the more wallet share from their either the PPMC business, the pre-policy medical health checkup or annual health checkup business as well.
And just to underscore one point, with Thyrocare, actually we are the best person for partnerships, whether you are a insurance player, a health tech player, or let's say a health clinic or a hospital chain, because we have a complete company-owned phlebotomy fleet, and we have a full tech backend that has been built. So today, with one single API integration, Thyrocare can enable you in 300 cities in the country. And that actually, as a proposition, is leading us to win in the franchisee network, in the partnerships business, because if you are a very large insurer, actually with one single API integration, you can start your entire pre-policy medical checkup and annual health checkup across 300 cities with just one partner, Thyrocare.
Yes, sir. So, sir, is this business granular, or the share of top 5-10 partnerships will be contributing 70 to 80% of revenue?
Actually, there is a long tail in this business, but you're right, the top 5 will account for 50-60% of the revenue.
Understood. And sir, if I look at the realization per test in partnership business, so it has been constantly declining. So it was around 345 in December 22 quarter, and now it is around 305. So what is the reason for the same?
Actually, that is realization per sample across the partnerships business. What happens is we have been focusing a lot on upsell, or let's say add-on tests at the patient's residence. So what happens is, as tests get add-on at the time of collection, an additional sample is used, but the realization of that sample is lower. So that mix is what you're seeing playing out in the revenue per sample. So I mean, it's just adding on customers adding on tests that they want to add on during the time of collection, which typically, if our average collection will be about 1,200 rupees, they're adding another 200 to 400 rupees of tests. So that is what is there, but that is an incremental revenue that comes at no additional cost. So that flows straight to the bottom line. But that is the effect you're seeing in the revenue per sample.
Understood, sir. And sir, is there a difference in margins between a franchisee business and a partnership business at a gross or an EBITDA level?
I'll let Nitin take it.
No, so it's not like that. So even if our partnership business is increasing at, say, a range of 29%, the EBITDA and the gross margin levels, they are fairly similar. So it will not dent our EBITDA margin. I think that's the question, that if the partnership business is growing at a faster rate than partnership, will there be an impact on EBITDA? Then the answer is no.
Understood. And sir, you mentioned that we have invested around 8 crores in Tanzania. So if you could just provide a brief outlook, how do you see this business shaping up in the next 3 to 4 years? So can this business become 7 to 8% of our revenue? If you could provide an outlook on our Africa business, that would be helpful.
Just to clarify, it is 4 crores from our side and 4 crores from our partner side. The total investment is 8 crores, but it's a 50-50 JV. So we've only put 4 crores. It's too early to say. It's our first foray into the market. We are understanding a new geography. It's the first time in a long time that we have done an international foray. The last was almost a decade ago in the Gulf, but now in Africa. So I think it's too early for me to give you a forecast, of where I think Tanzania will go. Maybe by the end of this year is when I think I will have full clarity on how much we can scale that business.
Sure, sir. Thank you, sir, for answering my questions. Thank you all very much.
Thank you.
Thank you.
We have our next question from the line of Aniket Kulkarni from BMSPL Capital. Please go ahead.
Yeah, good evening, sir, and thank you for the opportunity. So can you give some brief commentary on how competitive intensity has been in the market and what is the pricing situation which we are witnessing right now? Just a brief commentary will be fine.
This is Nitin's favorite subject, so I will let him take it.
I didn't get the full question.
What competition and pricing?
Competitive and prices, yeah.
Is competition increasing?
Yeah. No, so see, the competition, I feel, is slowly, I think, cooling down. I think initially the impact post-COVID was definitely a lot of competition coming in and decreasing prices and trying to win the market. But as the non-COVID business has stabilized over the last couple of years, we are now seeing some cooling of effects of the pricing decrease that the competition was doing. This has also led to we also stabilizing our prices. Like we said, we last year went live with our slab-based pricing, which led us to, sorry?
Mr. Kulkarni,
Which led to some of the goodness which led to some goodness on our side, and we now don't see that much intensity and price pressure from competition now.
Okay. Thank you so much, and best of luck for the coming quarters.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand over the call to Mr. Rahul Guha for closing comments. Over to you, sir.
All right. Thank you for all the questions and the engaging discussion. I look forward to seeing you in the next quarterly presentation, and have a fantastic evening, and I wish you a good day.
Thank you, members of the management team. On behalf of Thyrocare Technologies Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.